बिंदास।
जब मन में शांति हो तो जिंदगी में अलग ही मजा है। मेट लाइफ में हम ये बात समझते हैं और हमारा हर इंश्योरेंस प्लान आपके परिवार को रखता है सुरक्षित और भविष्य को सुनिश्चित। मेट लाइफ, मन की शांति गारंटी।
Korea sparkling.
Sujit, first on the DLF buyback, when a beaten down stock comes back with the news that it's going to make an offer on July 10th, it pulled up all the real estate stocks as well. Maybe they don't even have enough cash flows to make such an offer to their own shareholders. But is that reassuring for you or a danger signal?
No, I think it suggests the end of a trend. So in that sense, it is reassuring, since I do believe at these levels, especially at these levels, there's a lot of value. And I think, you know, it's not just hot air. I think if I were owning a company, I would certainly, and I knew the fundamentals well of the company, I would be buying back shares, because these are really extreme values. I mean, you know, just like one would have been a seller at 21,000, one's got to be a buyer at 14,000, and we are now 15,000 and even 16,000, and we are now 13,000 and 12,000 and change. So, no, I think that is yet another example. So what we've seen in the last 2-3 minutes is, you know, there are a couple of good news already surfacing. And, you know, and I agree with Maid. I think the question now is not when you sell, but listen, when do you put the money to work? Now, you know, given this, from my vantage point, and I guess any interpretation would be somewhat bullish scenario, there is the issue which all of us investors and fund managers have to incorporate. What if the oil price stays at this level and even makes a new high? You know, I think each succeeding new high will be that much less bad news, because in percentage terms, nobody is talking of a large percentage move in the price of oil. So even that bit of bad news, which will calm and certainly not lead to markets running up in a hurry, is not so bad, because really the real damage has done. I mean, markets are down 40, 50, or stocks are down 40, 50, 60% in a very short period of time. That's extensive damage. And in that sense, you know, all roads lead somewhat uphill from here. Or if you will, the prices lead somewhat upwards from here.
Meir, are you sensing that uphill trend, at least in capital goods space? Saw some nice bit of buying on Friday. I know you said you realigned your portfolio over the last couple of months, more on the defensive FMCG and pharma side. But are you getting back into capital goods and heavy machinery and equipment stocks?
Well, not in a tearing hurry, I would say, but obviously there is huge value that's gotten created. You know, to put things in perspective, in January when we started booking profits in the infrastructure space, essentially it was basically just on valuations. We had no questions on earnings growth really. We did expect the sector to grow net profits and top line both quite aggressively over the next 3 years or so. As far as the top line is concerned, I think visibility is still pretty high across the sector, because the order books reflect that they can sustain growth for at least the next couple of years without any serious slowdown on the top line. But incrementally, the negative that has happened in the last 6 months is commodity prices. If you look at the inputs like steel, cement, plastics in certain cases, a lot of the bitumen, for example, for the road builders, etc., a lot of the input costs have really skyrocketed in the last 6 months alone. So apart from valuations coming down, if everything else had been normal, we would be screaming buyers at these points in time. But we need to now factor in the fact that because of higher material cost for most of the contractors and the capital good makers, we have to now analyze what the impact is going to be on margin. So My guess is that we will wait for the numbers for the June quarter to come in, and maybe a little bit of the September quarter's number to come in, to see which are the companies which are getting impacted more, and versus which are the companies which are getting impacted less, and then take a call. Standalone, if nothing had changed since January, I would be a screaming buyer, but now I'll wait for the results to come in to see the impact on margins, because please understand that most of the companies work on very thin margins, net margins of anywhere between 5 to 10%. So even a 20% rise in raw material costs can be a significant, can make a significant dent as far as the bottom line is concerned. So the sensitivity of these companies' earnings to raw material cost is pretty high, and that's what we need to be careful about. That's basically the call on the sector.
Okay, my final question to both of you. Sujit, I'll start with you first. Expectations for the Q1 earnings season, which Mihir already referred to?
You know, that is, as I said, we don't know how much of the input costs have been absorbed, have gone up in this quarter. So I think, you know, my impression on that, and, you know, there are calculations for different sectors, etc., but that the market sentiment seems to have discounted more than perhaps what will show up. So in terms of expectations, the earnings will come out better. There's no question they'll come out worse than what we thought 3 months ago. But I think expectations have moved a lot faster downwards than what the earnings will turn out to be. So on average. So in that sense, I think just like in April, the same phenomena we saw, that there were a lot more earnings surprises, even though there was a slowdown, than the market had factored in. So I expect the same for the June quarter.
Any expectations from Infosys as a signal for the broader IT earnings?
Well, I can't really comment on specific stocks, but my guess is that most of the companies should be able to kind of at least meet their guidances. We don't expect any major negative surprises, at least in the large companies.
All right, Mihir Vora and Surjit Bhalla, many thanks, gentlemen, for joining us on D Street this week. So the prognosis seems to be what worse can happen from here. We've already lost nearly 37 to 40% on the mainline indices, the small caps, mid caps, much more than that. And perhaps now's the time for starting to look for value buying opportunities and growth stories where earnings